All right, let's unpack this. Have you ever looked at a company's financial statements and seen those lines for investments or securities and wondered what really goes on behind those numbers?
Mhm.
Like, how do huge corporations ensure their multi-million, even multi-billion dollar investments are absolutely on the up and up?
Right.
Or what exactly goes into verifying the true value of something that isn't openly traded on a public exchange?
Yeah.
Something that doesn't have a clear everyday price tag.
Yeah, this is a great question. And today, we're embarking on a crucial deep dive into the investment cycle. We're going to focus intently on the rigorous controls
Right.
and meticulous audit procedures that are really the backbone of financial transparency and accuracy in this, well, pretty complex area.
Okay.
Our mission today is to demystify this critical area for you, providing a real shortcut to truly being well-informed about how investments are not just managed,
Yep.
but meticulously handled and audited within a company. It's about appreciating the often hidden, painstaking work that builds genuine financial trust, allowing you as a stakeholder to feel confident in the numbers you see.
That's a perfect mission statement because for most of us, investments on a balance sheet just feels like a black box, doesn't it?
You really can, yeah.
So let's start at the absolute beginning. Why do we need such tight, almost ironclad controls around investments in the first place? What's really at stake here for companies and crucially for anyone relying on their financial statements, whether you're an investor, a lender, a potential business partner, or just trying to understand a company's true financial health?
That's a truly fundamental question, and it's where the entire discussion begins. Controls over investments are not just important, they are the very first line of defense, non-negotiable for any organization.
Non-negotiable. Okay.
They are absolutely critical because they protect against a multitude of financial pitfalls. Simple errors, which can snowball quickly, outright fraud, where assets are intentionally misappropriated or misstated, and, well, any form of misrepresentation in financial reporting, which can seriously mislead stakeholders.
Right. All the bad stuff.
Exactly. Think about it. If a company's investment portfolio, which can represent a substantial portion of its assets, is opaque, a black box, as you said, full of assets that could be manipulated or misstated, then all confidence in their financial statements just vanishes.
Gone.
Gone. Strong, well-designed controls are the bedrock upon which financial trust and accuracy are built, and that is paramount for anyone making decisions based on that information.
Mm.
Without them, the risk of financial collapse due to hidden losses or widespread fraud due to undetected theft just skyrockets. It's like the invisible architecture that prevents financial chaos.
That's an absolutely crucial insight. Without those foundational controls, the whole financial structure is essentially a house of cards.
Pretty much, yeah.
But controls can sometimes feel like a nebulous corporate term. Where do these critical safeguards actually start in practice? Is it purely about sophisticated software and systems, or something much more fundamental about, human roles and responsibilities within a company?
That's a great question, and it dives right into the heart of the matter. While technology definitely plays a role, the absolute foundation of these controls, especially in the investment cycle, rests on something far more fundamental: strong segregation of duties.
Segregation of duties. Okay, I've heard that term.
Right. It means meticulously ensuring that no single person or department has too much power or control over an entire transaction or a specific asset. It's designed to create checks and balances so that errors get caught and fraud becomes incredibly difficult to execute without, well, collusion.
Makes sense. So how does it break down?
We break this down into three crucial separations, forming the pillars of protection.
Okay, 3 crucial separations. Tell us about the first one.
First, we have the authorization of the purchase or sale of investments. Ideally, and this is the gold standard, the board of directors, operating at the highest level of governance within the company, should be the ones to formally authorize these significant investment decisions.
The board itself. Wow.
Yes, this top-level approval is absolutely vital because it prevents any single individual, say, a rogue finance manager or maybe a CEO with unchecked power from making unauthorized investment decisions.
Yeah, you can see the potential for problems there.
Exactly. Imagine the potential for disaster if one person had the unilateral power to commit millions or even billions of a company's funds, perhaps for personal gain or worse, to mask existing losses or poor performance.
All right.
The board brings a collective strategic perspective, ensuring investments align with the company's overall long-term goals, its stated risk appetite, and, its liquidity needs. This isn't just about preventing fraud, it's about strategic alignment and preventing even honest but potentially catastrophic mistakes from a single point of failure.
That makes perfect sense. Big decisions definitely need big oversight. It's a very high-level check.
Yeah.
So what's the next critical separation after authorization?
Next is the custody of investments. This refers to who actually holds or physically possesses the investment instruments themselves. This is where the physical security and safeguarding of the assets come into play.
Okay, the actual holding.
Right.
Right.
The key standard here, what every auditor hopes to see, is an independent third-party custodian. We're talking about a major bank or a specialized financial institution whose entire business is safeguarding assets for clients.
Like a brokerage firm or a trust company.
Exactly. The immense benefit of using an external objective party is that they are completely independent of the company's internal operations. This adds an extra robust layer of security and significantly reduces the risk of internal theft or manipulation. They are professionals with dedicated infrastructure, security protocols, and insurance designed specifically for asset protection. It's like having an ultra-secure vault for your company's treasure, run by someone entirely separate from those who decided to buy the treasure.
So they're the ultimate neutral expert vault keepers. But what if a company, perhaps a smaller one, doesn't use an independent custodian? Is there a minimum acceptable standard for custody within the company itself?
Absolutely, there is a minimum. If an independent custodian isn't used, the least acceptable control is joint control by at least 2 company officials.
2 people.
At least 2, yes. With the investments kept securely, often in a safe deposit box. This buddy system, or dual custody approach, acts as a crucial check, meaning no one person can access the investments alone.
Need 2 keys, essentially.
Right. It requires 2 sets of keys, 2 approvals, creating a simple yet surprisingly effective deterrent against individual malfeasance. Furthermore, if the investments are indeed held physically by the company itself, there must be periodic counting and reconciliation with the investment subsidiary ledger.
Like checking the list against what's actually there.
Precisely, and crucially, by a party not associated with managing or holding those investments.
Okay, someone independent internally.
Exactly. This is a critical internal audit function. It ensures that what's on the books actually matches what's physically there, and it's performed by someone completely objective who has no vested interest in the investment portfolio itself. It's about ensuring the people managing the investments aren't also the ones counting them.
That's brilliant. It's that classic trust but verify principle applied to the very heart of the company's assets. So, with the decisions authorized and the physical assets securely held, what's the final piece of this critical puzzle to ensure everything is transparent and above board?
The third crucial separation is record keeping. A party entirely separate from those authorizing or holding the investments must be responsible for keeping the detailed, meticulous records of all investment transactions and balances.
So, accounting, basically, but separate from the people doing the buying, selling, or holding.
Yes, exactly. This separation is paramount for ensuring accuracy and preventing manipulation. Imagine if the person who authorized a transaction or who physically held the asset also kept the records.
Too easy to hide things.
Far too easy. They could easily cover up errors, alter dates, or even completely hide fraudulent activities by simply not recording them or by misrepresenting them. By having a separate record keeper, you create another independent point of verification and an undeniable trail of evidence for every single investment transaction.
Right.
It's a foundational element of internal control that provides integrity and trustworthiness to the financial data. Without this separation, any audit becomes vastly more challenging, almost impossible, as there's no objective source of truth.
Okay, so we've walked through the crucial safeguards that protect a company's investments from within, from who decides to who holds and who records. It's like building the foundational security layers. But once all those internal gears have been grinding for a year and the financial statements are ready, who's the independent eyes that come in to verify everything?
That's the auditor's role.
Right, and before they even do that, how do companies ensure the value of these investments is right, especially when markets are constantly moving? That seems like a whole other layer.
It is, and that's where we transition from basic segregation of duties to the controls over processing transactions and, critically, fair value measurement.
Fair value.
The decisions made at the very inception of an investment's life can have a profound, almost game-changing impact on how its value is ultimately reported on the financial statements. This brings us to the initial classification of investments.
Classification.
Yes. Companies typically classify investments into distinct categories: trading, available for sale, AFS, or held to maturity, HTM. This isn't just an arbitrary label or an accounting formality. It fundamentally dictates how the investment's value changes, whether realized or unrealized, or reported on the financial statements, impacting key performance indicators.
How so?
This, for an auditor, is where it gets really interesting.
You're right. That sounds like a tiny detail with huge implications. Can you explain that a bit more? How does a label change everything about a company's financial picture?
Absolutely. This is one of the most fascinating areas because a single management decision can dramatically alter how a company's performance looks to the outside world. For instance, trading securities are like a company's short-term stock picks. They're bought to be sold quickly, often within a quarter or two, purely for capital gains.
Okay, quick flips.
Exactly. Any ups and downs in their market value, even if they haven't been sold yet, hit the company's net income immediately.
Directly to the bottom line.
Directly. Imagine if a tech giant held a huge trading portfolio and the market dips significantly one quarter. That dip would directly slash their reported profit, making their earnings look incredibly volatile. This can certainly send analysts and investors into a frenzy, directly impacting share prices.
So it's a direct, almost real-time reflection of market fluctuations on the company's reported profit. That sounds incredibly transparent, but also potentially terrifying for a CFO trying to manage earnings expectations.
Precisely. Now, contrast that with available-for-sale securities, or AFS. These are more like long-term strategic investments, not meant for quick profits, but also not necessarily held forever.
Kind of in the middle.
Sort of. The critical difference here is that their unrealized gains and losses, again, changes in value before they're sold, bypass the income statement entirely. They reported in a separate area called Other Comprehensive Income, or OCI,
OCI, okay.
which is a component of equity, but crucially, it doesn't impact that all-important net income figure for the period.
That's a massive difference. So company A with a bunch of trading securities could have its stock price plummet on an earnings miss largely due to unrealized investment losses.
Potentially, yes.
While company B, with similar market dips on its available-for-sale portfolio, might report stable profits because those losses are parked elsewhere, in what's sometimes called a back pocket of equity.
That's a good way to think about it.
For us, the listeners, this reveals a crucial lens. You need to look beyond just the net income number if you want to truly understand a company's full financial picture and where the potential hidden volatility or stability might lie. You have to look at OCI too.
Exactly. It's about understanding the nuances of how volatility is reported and where you need to dig deeper as a financial statement user. And then you have held-to-maturity securities, HTM.
Held to maturity. Sounds straightforward.
These are almost exclusively debt investments like corporate bonds that the company has both the ironclad intent and the financial ability to hold until they mature.
Intent and ability. Both.
Both are critical. Because management intends to hold them, regardless of market fluctuations, their fair value isn't considered relevant for the balance sheet, generally. For these, market fluctuations are largely ignored. They're typically reported at amortized cost.
Okay, amortized cost. Could you simplify that a bit more? What does that really mean for the value reported on the balance sheet?
Sure. Think of amortized cost for a bond like this. You buy a bond, maybe for slightly more or less than its face value, that's a premium or a discount. Amortized cost smooths out that premium or discount over the bond's entire life.
So it adjusts the carrying value over time?
Yes, it adjusts the carrying value gradually so that by the time the bond matures, the carrying value equals the face value you get back. It reflects the true economic yield or effective interest rate the company is earning, not just the initial purchase price or the day-to-day market swings.
Got it. It's a way to match the cost to the expected return over time.
Exactly. Auditors recalculate this to ensure the company isn't artificially inflating or deflating its investment value over time based on just simple purchase cost.
So management's intent becomes this incredibly powerful accounting lever, determining whether market swings hit profit now, later via OCI, or almost not at all with HTM.
It really does.
How do auditors possibly verify intent, which feels inherently subjective? Can a company just reclassify these willy-nilly to make their numbers look better?
That's precisely the challenge. And it's a critical area for auditor skepticism. It's not as simple as just asking management, what's your intent?
Right, they just say what sounds best.
Probably. Auditors have to corroborate management's stated intent with other objective evidence. This includes reviewing historical behavior. Has the company actually held similar investments to maturity in the past? Or they tend to sell them early?
Looking at their track record.
Yes. They'll look at cash flow forecasts Does the company have sufficient liquidity that they don't need to sell these investments prematurely? They'll examine board meeting minutes and management discussions where investment strategies are debated and documented.
Digging into the internal discussions.
Absolutely. They'll also consider the nature of the securities themselves and market conditions. For example, if interest rates suddenly spike, a company might suddenly find it more attractive to sell an old low-yield HTM bond and buy a new higher-yield one.
Temptation to sell.
Right. In such cases, if they lack the ability to hold or the intent genuinely changes, a reclassification might be necessary, and auditors need to ensure that reclassification is justified and properly disclosed according to GAAP rules. It's a complex area where judgment and professional skepticism are absolutely paramount.
That brings us to fair value estimates then. Beyond just the classification, how do companies ensure the actual numbers representing fair value are reliable, especially for things that aren't just simple stocks?
Precisely. Beyond classification, controls surrounding how fair value is estimated, whether internally by the company's own experts or by a third party, are paramount. These methods can be incredibly complex, especially for investments that don't trade on active public markets where there isn't a readily available stock quote.
Like private company shares or complex derivatives.
Exactly. The company needs robust processes for collecting relevant, reliable data, applying appropriate, generally accepted valuation models, and regularly reviewing and updating those estimates. If they're valuing a private equity stake or a complex derivative, they'll need highly skilled internal valuation teams or external specialists.
And the auditor's job?
The auditor's job is to then understand these methods thoroughly, assess the inputs used, and crucially, assess their reasonableness and reliability against accounting standards like GAAP.
So, once all these internal controls are meticulously put in place and the company has prepared its financial statements, the independent auditors step in. What are they truly looking for? How do they confirm everything is as it should be, especially given all these classification nuances, subjective intents, and complex fair value estimates? What's their core mission here?
The auditor's mission fundamentally is to obtain sufficient, appropriate audit evidence.
Sufficient appropriate audit evidence. Okay.
Right. Enough high-quality evidence to provide reasonable assurance that the financial statements are free from material misstatement, whether that misstatement is due to error or fraud.
Reasonable assurance, not absolute guarantee.
Correct. An audit isn't designed to find every single tiny error. For investments, this evidence is needed for various forms, traditional debt and equity securities, but also loans, advances, and maybe more esoteric financial instruments. We primarily approach this through two main complementary types of audit procedures.
And what are those two main approaches?
First, we have substantive tests of details. These primarily focus on the ending balance in investment accounts and the presentation and disclosure in the financial statements.
The final numbers and the footnotes.
Exactly. This is essentially looking at the final picture, the numbers presented on the balance sheet and in the footnotes, and verifying their accuracy and completeness by drilling down into specific transactions and balances. It's like checking the numbers line by line, account by account, ensuring every dollar is accounted for and correctly categorized.
So, a deep dive into the granular data, making sure the final balance is right. And the second approach.
The second approach is analytical procedures. These are used to test the reasonableness of related gains, losses, and investment income.
Reasonableness, like looking for things that don't make sense.
Exactly. This involves looking for unusual patterns, significant deviations from expectations, or relationships that simply don't seem logical. For example, if a company reports a massive amount of investment income but has a relatively small investment portfolio, that would immediately raise a red flag.
Or if interest income doesn't line up with the bonds they hold.
Precisely. Or if expected interest income from bonds doesn't align with stated interest rates and the principal amount. These two approaches, substantive tests of details and analytical procedures, complement each other perfectly. One focuses on the granular detail and specific transaction verification, the other on the broader picture and overall reasonableness. They help us efficiently identify areas that warrant deeper, more focused investigation, creating a powerful synergy.
So they work together.
They absolutely do. What's fascinating here is how these two approaches work in concert to build a complete, reliable picture of the investment portfolio.
Okay, so they're looking at the big picture for anomalies and then drilling down into the tiny details to confirm accuracy. Let's start with auditing the investment balance, which is that snapshot view at a specific point in time, usually year-end. Imagine a puzzle. The very first thing you want to know is, do I have all the pieces? How do auditors ensure all investments are accounted for? How do they confirm completeness?
That's absolutely right. Completeness is crucial. We want to ensure that all assets that should be recorded are indeed recorded, and that none have been intentionally or unintentionally omitted.
Making sure nothing's missing.
Exactly. For entities with a high volume of material investment transactions, auditors will often perform what's called a search for unrecorded purchases of securities. This involves examining transactions for a few days after the year end.
After year end. Why?
The logic here is to catch any purchases that might have occurred right before the year end, but were deliberately or accidentally delayed in being recorded until the new year. This helps prevent a company from understating its assets at year end.
Ah, checking for things pushed into the next period. Clever.
It is. Additionally, auditors will confirm securities held by independent third-party custodians or physically count securities on hand if they are held directly by the company.
Confirmations and counting.
Right. While these procedures primarily test existence, meaning do the investments actually exist, they also contribute significantly to completeness by providing independent, objective evidence that all securities that should be present are indeed present and accounted for, either with a custodian or physically within the company's vault.
So confirming they exist also helps confirm you have the whole list.
In a way, yes. If a custodian confirms holding a certain number of securities, it provides strong evidence that those securities are there and thus complete within the custodian's records, matching what the company claims.
Okay, we know everything is there. Now, is it valued correctly? And is it categorized properly? How do auditors approach valuation and allocation? This seems like it could be incredibly complex, especially for non-publicly traded assets.
It definitely can be. For valuation and allocation, a critical initial step is to obtain and foot a detailed listing of investments by category.
Footing, just adding it up.
Yes, segregated by trading, available for sale, held to maturity, and equity method investments. Footing just means summing up the columns to check for mathematical accuracy. Sounds deceptively simple, but when you're looking at a portfolio with potentially thousands of individual investments and transactions, this is where simple human error or even intentional miscalculation can creep in and throw off the entire balance.
Right. Basic math check first.
After summing, we then agree the totals to the general ledger, ensuring consistency across all records. This is a foundational step for numerical accuracy in ensuring the internal detailed records match the broader financial system.
Like a basic cross-check before digging deeper, a sort of mathematical sanity check.
Precisely. Then, auditors review the schedule of investment activity, basically, the list of purchases and sales during the year to obtain evidence of any additions and subtractions that occurred. This helps verify the movement of investments, ensuring that purchases and sales were properly authorized, accurately recorded, and make logical sense in the context of the company's stated investment strategy.
Checking the ins and outs.
Exactly. A crucial step is also to obtain evidence corroborating the quoted year-end fair value. This is where we compare the values assigned by the company to prices published by various independent sources.
Like stock exchanges.
Yes, these sources can be exchanges registered with the SEC, other reliable financial information services like Bloomberg or Reuters, or directly from a third party like an independent broker-dealer or appraiser who specializes in valuing specific, less liquid assets.
Getting outside validation.
Critically important, the importance of independent verification here cannot be overstated. It's a crucial safeguard against internal over- or undervaluation, which could artificially inflate or deflate the company's financial health.
So, using external, trustworthy sources to back up the company's numbers. What about investments not reported at fair value, like those held-to-maturity ones we talked about earlier? How are they checked?
For those, we recalculate their ending values. For instance, investments classified as held-to-maturity, HTM debt securities, should be valued at amortized cost at year-end.
Recalculating the amortization.
Yes. As we discussed, amortized cost, simply put, is the original cost of the investment adjusted over its life for any premium or discount paid at purchase. It essentially smooths out the purchase price over the life of the debt to reflect its true economic yield.
Okay.
Then, for investments where the entity has significant influence over another company, typically indicated by owning 20% to 50% of their voting stock, they are accounted for using the equity method.
Equity method.
Right. Here, the investment's value reflects the investor's share of the investee's net income, adjusted for dividends received. So if the investee earns income, the investment value increases by the investor's share, and it decreases when dividends are paid out. It's a dynamic valuation that mirrors the underlying performance of the investee. Auditors need to verify those calculations based on the investee's financials.
That makes the valuation process sound quite dynamic and intricate. What else do auditors meticulously examine for valuation and allocation?
Auditors also have a critical responsibility to determine whether there has been any permanent impairment in the value of individual securities.
Impairment. We'll definitely need to dig into that later.
We will. It's a crucial, often subjective area requiring very careful judgment as to whether a decline in value is temporary, a passing market fluctuation, or a more lasting fundamental loss that needs to be officially recognized in the financial statements. This isn't always clear-cut.
Seems tricky.
It is. Finally, and this is where significant judgment comes into play, we assess the reasonableness and appropriateness of assumptions, market variables, and valuation models used by the company. This is especially true in areas where fair value estimates are complex, like for Level 3 investments we'll discuss later, and of course the reasonableness of any reported decline in fair value. This involves a deep dive into the inputs, the methodologies, and the expertise of those performing the valuations.
Now, the flip side of completeness, are these investments actually real? Do they physically exist? How do auditors confirm existence? This seems like it could be a challenge, especially for digital assets or those held overseas.
Well, the two primary, most robust tests of existence for investments are confirmations of securities held by third parties and the physical examination of securities on hand.
Confirmations again.
Yes. For securities in the possession of third-party custodians, like banks or specialized financial institutions, we send direct confirmations to them. This means a formal request, often electronic now, directly to the custodian, asking them to verify what they're holding on behalf of our client at a specific date.
Straight from the horse's mouth.
Exactly. It's also advisable to send confirmations to broker-dealers and other counterparties for any unsettled transactions, providing strong, independent evidence that the investments genuinely exist and that the company indeed has a right to them.
So, getting direct, unbiased confirmation from the source. What about physical examination? That sounds a bit old school in a digital world. Are there still paper certificates?
Sometimes there are. And even if not, the principle applies. An examination of the securities on hand, the actual physical certificates, if they exist, should be made to coincide with the examinations of other liquid assets, such as cash.
At the same time as cash. Why?
This procedure is absolutely crucial for fraud prevention. It prevents the concealment of theft by making it impossible for one asset to serve as a substitute for another.
Ah, preventing shell games.
Precisely. You know, when auditors walk into a client's vault to physically count securities, it's not quite like a Hollywood heist movie. There are no laser grids.
Oh.
But it's often done simultaneously with counting cash. It's a classic anti-fraud technique that prevents what we call asset swapping.
Got it.
Imagine if a company was trying to hide a cash shortfall. Without these simultaneous checks, they could potentially just point to an investment certificate and claim it's the missing cash, or vice versa. That's why this seemingly mundane physical count is actually a crucial deterrent against internal theft.
Okay.
During this physical count, the auditor examines the face of the investment instrument to determine if ownership is correctly recorded, looking for names, serial numbers, and other identifying details. They then record the details of the security count on a worksheet, which should also include an acknowledgement by the client that the securities were returned intact.
Documenting everything.
Always. If a safe deposit box is used, the security should ideally be counted precisely on the balance sheet date, or the bank should be requested to seal the box until the count can be completed later, ensuring no manipulation can occur between the balance sheet date and the actual count.
That sounds incredibly meticulous, preventing even the most inventive attempts at deception. And you mentioned a third test for existence related to interest earned. How does that work?
Yes, there's an expectation that interest earned on an investment in a debt security will agree to the effective interest rate that was calculated when the security was purchased.
The expected yield.
Right. The auditor may perform analytical procedures to obtain evidence that the interest earned does not materially differ from this expectation. What's fascinating here is how even something as seemingly passive as consistent interest income can tell an auditor if an investment really exists.
How so?
If a security is reported to exist and generate income, but no interest is being received, or the amount is vastly different from what's expected based on the effective interest rate and principal, that's a major red flag. It could indicate the security isn't real, or at least isn't held by the company, or isn't performing as expected, which also ties back to valuation and potential impairment. It's an indirect but powerful piece of evidence, like a pulse check for the investment.
Okay, so we've established they exist, they're valued right, But are they truly ours? And are there any hidden obligations or strings attached to them, like being pledged as collateral? How do auditors verify rights and obligations?
Well, the confirmation of securities held by third parties and the physical count of securities on hand
Mm.
directly provide very strong evidence of the entity's ownership, their rights to those investments.
Because the custodian says they hold it for them, or they physically have it.
Exactly. If a third-party custodian confirms they hold specific securities for the company, or if the company physically possesses them, that strongly indicates legal ownership. Additionally, the auditor will often examine brokers' advices for a sample of securities purchased during the year.
The paperwork from the purchase.
Right. These advices are official documents from the broker, confirming the purchase, detailing the transaction, and crucially, verifying that the entity is the rightful owner and the transaction was legitimate. This process helps ensure that the company indeed has the legal rights and benefits to the investments listed on its books.
And the obligations part, pledged as collateral.
Yes, we proactively start to look for indications of whether investments have been pledged as collateral for loans or other obligations. This is usually done through inquiries with management, reviewing loan agreements, and looking at board minutes. It's a critical disclosure point we'll cover more extensively later, as it fundamentally impacts the company's ability to freely use or sell that asset. It affects their rights.
That covers the snapshot of the investments at a specific point in time. But companies are constantly buying and selling, and income is flowing in. So let's shift to auditing investment transactions, what you call the flow view throughout the year. How do auditors ensure the completeness of income from investments, making sure all the dividends and interest got recorded?
For income completeness, the auditor typically performs analytical procedures testing the reasonableness of dividend and interest income.
Analytical procedures again, comparing expected versus actual.
Exactly. By comparing recorded income to what's expected based on the investment balances held during the year, prevailing interest rates, and publicly available dividend policies from the issuing companies, they can identify if all investment income seems to have been recorded.
Like, we held X amount of this bond, the rate is Y, so we should have received Z in interest.
Precisely. They might calculate the expected interest income from all debt securities held, based on their principal amounts and coupon rates, and compare that to the reported interest income. If there are significant discrepancies, it prompts further investigation into what might be missing or misstated. It's a high-level check to ensure nothing obvious is falling through the cracks.
And what about ensuring everything is recorded in the right accounting period? That sounds like a classic area for manipulation, to push sales or income into a different period to smooth earnings or meet targets.
It absolutely is, and it's addressed by the cutoff procedure. A thorough cutoff review is performed to ensure that purchases, sales, and investment income were recorded in the proper accounting period.
Checking transactions right around year end.
Exactly. This is absolutely crucial because misstating transactions across periods can distort a company's financial performance for that specific quarter or year. For instance, intentionally recording a large investment sale that actually occurred in January of the new year as if it happened in December of the prior year could artificially boost year-end profits, making the company look better than it truly was at that specific date.
Or pushing expenses into the next year.
Right. Auditors meticulously examine transactions occurring around the year-end date, say, the last week of December and the first week of January, looking at shipping documents, contract dates, cash receipts, etc., to ensure they are booked in the correct period.
So making sure the timing is correct for all transactions, almost down to the hour sometimes.
Yeah.
And for valuation, allocation, and accuracy of those changes over time, like gains or losses from sales or the amortization we talked about.
Here, auditors perform independent calculations to determine the validity of recorded gains or losses from security sales. They'll look at the purchase cost basis and the sale proceeds and calculate the gain or loss themselves.
Not just taking the company's number.
Definitely not. They also recalculate to verify the accuracy of discount and premium amortization on debt securities over the period. They don't just take the company's word for it. They recalculate it themselves, often using sophisticated software or detailed spreadsheets to verify every number.
And verifying income accuracy, too?
Yes, in addition, a recalculation should be made to determine the accuracy of recorded dividend and interest income during the period. For example, investment income from dividends may be recalculated by comparing recorded income with dividend records produced by independent investment advisory services, such as Moody's or Standard & Poor's, which track dividend payments for various securities.
Using external data sources to check the company's records.
Correct. This external, independent verification adds another critical layer of assurance that the income streams are accurate and legitimate.
That makes perfect sense. So for income, the analytical procedures you mentioned earlier for completeness also double as evidence for existence and occurrence, right? If the income is there and looks reasonable, the underlying investment must exist and the income event must still happen.
Exactly right. The very analytical procedures performed to test the reasonableness of dividend and interest income, like comparing expected interest to actual interest, also provide strong evidence of the existence and occurrence of investment income. If interest or dividends are being consistently received as expected, and these payments can be corroborated with external data, it strongly suggests the underlying investment exists and that the income transactions actually occurred as claimed. It's a powerful indirect test that connects the flow back to the balance.
And finally, when it comes to transactions, how do auditors ensure the understandability of presentation and classification? This feels like it goes back to that trading versus available for sale distinction we talked about and making sure unrealized gains losses go to the right place.
It absolutely does, and it's vital for financial users. The auditor examines a sample of investment transactions throughout the year to determine that they were recorded in the proper accounts. This is crucial for accurate financial reporting and ensuring users aren't misled.
Checking the debits and credits went to the right spots.
Essentially, yes. For example, unrealized gains and losses on available-for-sale debt securities should be recorded in Other Comprehensive Income, OCI, which impacts equity directly but bypasses net income for the period.
Right, parked in equity.
In stark contrast, unrealized gains and losses on equity investments and debt investments classified as trading securities should be recorded directly in earnings or net income.
Hitting the bottom line immediately.
Exactly. The distinction here is massive for financial users. Reporting an unrealized gain or loss in net income directly affects the company's reported profit or loss for the period, which is a key performance indicator often scrutinized by the market. Reporting it in Other Comprehensive Income means it affects the overall equity, providing a fuller picture of value, but it doesn't hit that core profitability number immediately.
So you have to look in both places.
You really do. Understanding this difference is critical for users interpreting a company's true financial health and performance. It highlights where the volatility is truly impacting the company's reported results versus its overall equity position. Auditors verify this classification is applied correctly transaction by transaction.
That's a deep dive into the nuances of where these numbers end up and why it matters so much to those trying to understand a company. Now let's talk about the very end of the cycle. Presentation and disclosure. This is the transparency view, the final layer of what the public gets to see in the footnotes. How do auditors ensure completeness of disclosures related to investments, making sure everything that should be disclosed is disclosed?
Completeness of disclosures is paramount for transparency and assuring full context. The auditor must ensure that all required disclosures related to investments have been included in the notes to the financial statements.
All the required fine print.
Exactly. This means meticulously checking against the specific, extensive requirements of generally accepted accounting principles, or GAAP, or IFRS, depending on the jurisdiction. These disclosures are vital because they provide context, detailed breakdowns, risk information, fair value hierarchy details, and assumptions that the main financial statements simply can't convey on their own. They allow users to fully understand the nature, risks, and assumptions behind the company's investments.
Yeah, the footnotes can be pages long sometimes.
There can be, especially for complex investment portfolios. Without these footnotes, the main numbers are essentially meaningless to an informed reader trying to make a decision. Auditors use checklists and their knowledge of GAAP to make sure nothing required is missing.
So making sure all the fine print, all the crucial details are there, and for valuation, allocation, and accuracy within those disclosures. Are the numbers and descriptions in the footnotes themselves accurate and consistent with the audit findings?
Precisely. The auditor meticulously reads the footnotes and any other supplementary information related to investments to determine whether the information presented is accurate and whether the amounts disclosed are appropriate and consistent with what they found in their detailed testing.
Checking consistency.
Yes. This isn't just about the numbers themselves on the balance sheet, but how they're described, categorized, summarized, and explained for the reader in the narrative sections of the financial statements. Every figure, every statement in the notes must be consistent with the underlying audit evidence gathered during the audit.
And what about those rights and obligations we touched on earlier, especially that pledged as collateral aspect? It sounds like that could be a huge hidden risk if not properly disclosed. How is that handled in disclosures?
For rights and obligations and occurrence, the auditor specifically inquires of management and reviews internal documents like loan agreements, credit facilities, and board minutes to determine whether any investments have been pledged as collateral for loans or other company obligations.
Finding the strings attached?
Exactly. This is a critical disclosure point because it fundamentally means the company's ownership of those assets isn't entirely free and clear. They're essentially tied up, acting as security for debt. You absolutely need to know that as an investor or lender because it affects the company's liquidity and risk profile significantly.
It means they can't just sell that asset easily if they need cash.
Correct. The auditor also compares these disclosures about pledged assets and other matters to other audit evidence obtained throughout the engagement to ensure that all disclosed information related to investments has actually occurred and is factual, not just something vaguely stated without basis.
Yeah, and finally, ensuring the disclosures are crystal clear and easy to understand. It sounds like the ultimate goal is comprehensibility for the end user, not just checking boxes.
Yes, for understandability, presentation, and classification within the disclosures, the auditor meticulously reads all required disclosures for clarity, precision, and comprehensibility. They evaluate whether the language is plain and not overly technical or misleading.
Avoiding jargon where possible.
Trying to, yes. They also review and evaluate the methods used to account for, classify, and value securities, ensuring those methods are clearly explained and justified within the notes, particularly the assumptions behind fair value estimates. If we connect this to the bigger picture, clear presentation ensures stakeholders truly understand the company's financial position rather than being confused or misled by opaque language or overly complex accounting. It underpins the trustworthiness and reliability of the entire financial report, which is the auditor's ultimate objective.
Okay, now that we've covered the general audit approaches for balance, transactions, and disclosure, let's dive back into those critical classifications we mentioned. Trading, available for sale, and held to maturity in the context of marketable securities. You said classification changes everything, and it really does. What are the specific nuances auditors must consider regarding their valuation and reporting on the statements?
It's absolutely crucial because, as we've seen, the initial classification dictates the entire accounting treatment and how financial statement users interpret the company's performance and risk profile. For equity and debt securities classified as trading or available for sale, specifically where the investor has no significant influence over the issuer, they are carried at fair value.
Mark to market.
Essentially, yes. Their value on the balance sheet fluctuates directly with market prices. For these, companies are also rigorously required to disclose a fair value hierarchy, level 1, 2, or 3 in the footnotes.
We definitely need to unpack those levels.
We will shortly. This hierarchy indicates the reliability and observability of the inputs used in the fair value measurement. Level 1 being the most reliable, quoted prices. Level 3 being the least unobservable inputs, lots of judgment. This is a critical piece of information for auditors and users alike, as it tells you how much judgment went into valuing that asset.
Right, and HTM is different.
In stark contrast, held-to-maturity debt securities are carried at amortized cost, meaning they are generally not adjusted to fair value on the balance sheet unless there's a serious permanent impairment. This difference fundamentally changes how volatility affects the reported numbers.
And how do these classifications affect how they literally show up on the balance sheet, whether as current or long-term assets, and where their gains or losses are reported in the income statement or OCI?
That's a key distinction auditors verify. Equity investments and debt investments classified as trading securities are always reported as current assets,
Always current. Why?
regardless of when management expects to sell them, because their very nature implies short-term liquidity or intent to profit from short-term price changes. Any unrealized gains and losses from changes in their fair value are reported directly in net income.
Hitting the P&L.
Yes. This means their daily or quarterly fluctuations can make a company's reported profit or loss quite volatile, directly impacting the bottom line. Available for sale debt securities and held-to-maturity debt securities, however, are classified as either current or long-term assets based entirely on management's intent and ability regarding the timing of sale or maturity within the next operating cycle, usually 1 year.
Based on intent again.
Yes. And a significant difference here, as we touched upon, is that unrealized gains and losses on available-for-sale securities are reported in other comprehensive income, OCI, completely bypassing net income and going directly into equity.
The back pocket.
Right. This separation is crucial for financial statement users to understand how changes in value impact the core profitability versus the overall financial position. It's like separating operational earnings from investment market swings. Auditors check that these classifications and reporting locations are correct based on GAAP.
So, management's intent and ability is a huge, almost subjective factor here, impacting both classification, trading, AFS, HTM, and whether an investment is current or long-term. How do auditors truly deal with that subjectivity? It sounds ripe for potential manipulation or at least very careful scrutiny. Can management just change their mind easily to window dress their financial statements?
That's a critical and often challenging point for auditors. Auditors must constantly inquire of management and obtain written representation concerning management's intent and ability with respect to holding versus selling securities in the near term or holding debt to maturity.
Getting it in writing.
Yes, but that's not enough on its own. This is indeed subjective, as intent can genuinely change, but it's crucial for justifying the classification. The auditor needs to corroborate management's stated intent with other objective evidence.
Like what?
This means scrutinizing factors, like the company's historical investment patterns. Do they actually tend to hold similar investments for the stated period? What are their cash flow forecasts saying? Do they have enough liquidity that they don't need to sell these securities prematurely to meet operating needs? Are there board minutes discussing the strategy? Are there any contractual obligations or regulatory requirement that would prevent them from holding or selling?
Looking for consistency and constraints.
Exactly. While management can change intents, it usually requires significant justification, a change in circumstances perhaps, and must be consistent with objective evidence. Auditors are highly skeptical of reclassifications, especially from HTM or AFS to trading, that conveniently improve reported earnings without strong underlying business reasons. Such changes also trigger specific disclosure requirements.
So, what happens when our investment's value is tied not to public market prices, but directly to another company's financials, especially when we have significant influence, like using the equity method we discussed briefly earlier, like if we hold 30% of another company and we're relying on their numbers to value our investment?
That's a fascinating and complex area, especially for auditors, because you're essentially auditing another company's financial health indirectly to support the value on your client's books. When investments in securities are valued based on an investee's financial statements, for example, when the company holds a 20–50% stake and uses the equity method, the auditor needs to perform specific procedures to obtain reliable audit evidence regarding that investee's financial results.
What kind of procedures?
First, they will obtain and carefully read the financial statements and audit report of the investee, if available. This is the starting point to understand the financial health and performance of the company being invested in. You're relying on their auditor's opinion, in a way, assuming they have one.
And what if those financials aren't audited? Or if their audit report isn't satisfactory? What if they're not reliable enough for your audit? Say it's a private company investee with no audit.
That's a significant red flag and a challenge. If the investee's financial statements are not audited, or if their audit report is unsatisfactory, perhaps it's qualified, or there's a going concern issue mentioned, the auditor would then request that the entity, their client, arrange with the investee to have those financial statements audited.
Ask them to get an audit. That could be tough.
It can be, especially if the client only holds a minority stake. It requires cooperation. But it's necessary to get sufficient appropriate evidence if the investment is material. Furthermore, if the carrying amount of the investment on the entity's books reflects factors that are not recognized in the investee's financial statements, or if fair values assumed by the client are materially different from the investee's own carrying amounts.
Like if the client thinks the investee's assets are worth way more than their books say.
Exactly. Maybe due to unrecorded intangibles or different asset valuations. In that case, the auditor must obtain sufficient appropriate evidence regarding those differences. For example, if the entity has internally assessed a fair value for the investee that's wildly different from the investee's own book value or audited net assets, the auditor needs to understand and verify the comprehensive basis for that difference, potentially even needing to perform some audit procedures on the investee's underlying assets or assumptions directly, or engaging a valuation specialist.
That makes a lot of sense. So it's essentially a deep dive into the underlying company's numbers to support the investment value. And what if the two companies, the investor and the investee, have different financial reporting periods? That sounds like an accountant's nightmare for comparability, like one ends in December, the other in June.
It absolutely can be a headache. If there's a material difference between the financial statement periods of the entity and the investee, for example, one company reports in December and the other in March or June, The auditor needs to determine whether management has properly considered this lack of comparability and assess the effect, if any, on the auditor's own report.
How do they deal with it?
Management might need to obtain or prepare interim financial statements for the investee that align more closely with the investor's year-end. If the gap is significant, say more than 3 months, often specific procedures are required by GAAP to adjust the investee's results to the investor's period. The auditor needs to understand how those different year-ends are reconciled and if it impacts the accuracy of the investment's reported value, including the share of income recorded. It can add significant complexity to the audit, making sure that an investment based on a March snapshot is accurately reflected in a December financial statement.
Okay, let's tackle this fair value concept head on. This term pops up everywhere in financial reporting, especially for investments. What exactly does it mean in an auditing context, and why is it so critical and sometimes contentious?
Fair value is absolutely a cornerstone of modern financial reporting, you're right. It's formally defined under GAAP as the amount at which an asset could be sold or a liability could be settled in a current transaction between willing parties at the measurement date.
Willing parties, current transaction, key bits.
Absolutely. Willing parties implies a transaction where neither party is forced to buy or sell. It's an arm's-length deal. And current transaction means what the price would be right now at the measurement date, like year-end, not based on past prices or future hopes. It implies an orderly market transaction, not a distressed or forced liquidation sale. Certain financial assets and liabilities, particularly marketable securities like trading and AFS and derivatives, are either required to be presented or disclosed at fair value in the financial statements because it's believed to provide the most relevant information to users about their current economic worth.
That sounds reasonable enough in theory. But how do we actually measure fair value? Is it always straightforward, like looking up a stock price on the New York Stock Exchange? Or does it get more complicated, as you hinted?
Oh, it definitely gets more complicated. GAAP establishes a 3-level hierarchy used to measure fair value, moving from the most objective and verifiable inputs to the most subjective and judgment-based inputs.
Okay, level 1, 2, 3. Let's break those down. What's level 1?
Level 1 is the gold standard. These are observable, quoted prices in active markets for identical assets or liabilities. Think of a stock price for IBM on the NYSE, or Apple on the NASDAQ, or certain highly liquid government bonds or commodities.
Actively traded, identical item.
Exactly. This is the easiest for both the company to determine and the auditor to verify because the price is right there, published for everyone to see, reflecting real-time frequent transactions. If a quoted market price is available from an active market, this should always be the method used. It's considered the most reliable evidence of fair value.
That sounds like a dream for an auditor. Just look up the price, verify it. But I imagine it's not always that easy. What happens if that direct market price isn't available? What's level 2?
Exactly. Then we move down the hierarchy to level 2. These are observable inputs other than quoted market prices included within level 1 for identical assets or liabilities.
Okay, still observable, but not a direct quote for the exact thing.
Right. When level 1 prices aren't available, we look for other directly or indirectly observable inputs. The most common examples are quoted prices for similar assets or liabilities in active markets, like a similar corporate bond, or quoted prices for identical or similar assets in markets that are considered not active, meaning transactions are infrequent. It could also include inputs like interest rates, yield curves, or volatilities that are observable in the market and can be used in valuation models.
So using market data, but requiring some adjustment or inference.
Precisely. This is a step down in certainty from level 1, because you're either using similar assets, which require some judgment to adjust for differences, or less active markets, meaning there's some estimation involved and the prices aren't as robustly supported by frequent transactions. But the inputs are still based on observable market data.
So close, but not perfectly identical or in a super liquid market. And what's the most challenging, the most judgment-intensive level for both the company and the auditor? Level 3.
That would be level 3. These are unobservable inputs. They rely on estimates and valuation methods, such as discounted cash flow models or option pricing models, determined based purely on management's judgments and assumptions about what market participants would use if a market existed.
Unobservable inputs.
Yeah.
Management's best guess, basically.
Well, it should be more rigorous than just a guess. But yes, this is where it gets really interesting and, frankly, quite complex and subjective for auditors. This raises an important question. How do auditors verify something based purely on internal estimates, where there's no direct market observation to confirm it?
Right.
If quoted prices aren't available, level 1 or 2, Estimates of fair value may come from broker-dealers providing non-binding quotes, other third-party pricing services using proprietary valuation models, or the entity's own internal valuation model that they've developed using their own assumptions.
So internal models or external estimates not based on direct market prices.
Correct. In these cases, the auditor must ensure that the pricing source doesn't have a relationship with the entity that would impair its objectivity. They also need to consider obtaining further estimates or performing additional testing if subjective information was heavily used in the valuation process. This is the realm of complex derivatives, private equity stakes, distressed debt, or illiquid alternative investments where active markets just don't exist.
So management comes up with these numbers, especially those tricky level 3 ones, which are inherently based on their judgment and assumptions. What exactly does the auditor do to verify them, especially when it's not a clear-cut level 1 price? What's the auditor's specific responsibility here when dealing with fair value measurements? It sounds like a huge area of risk.
It absolutely is. Fair value measurements are essentially a type of accounting estimate, and often a very significant one. So all audit requirements related to accounting estimates apply here, but with added complexity due to the unique nature of fair value inputs and models. The auditor's ultimate goal is to obtain sufficient appropriate audit evidence to provide reasonable assurance that fair value measurements and disclosures conform to GAAP.
Reasonable assurance again.
Yes. They aren't guaranteeing perfection or predicting the future, but rather providing a high level of assurance that the numbers are reasonable and comply with the rules. To do this, the auditor must first understand the entity's process for determining fair value measurements and disclosures, as well as the applicable financial reporting framework they're using.
Understand how they do it.
Exactly. They also need to understand the identified controls that management has put in place over fair value measurements. Are there review processes? Is data input verified? Are the models validated?
And then they assess the risks, right?
Yeah.
Where are the blind spots, the areas most prone to error or manipulation, especially with level 3?
Yes, precisely. They separately assess the inherent risk and control risk related to the fair value measurement, which helps them tailor their audit procedures to the areas of highest risk. For instance, level 3 valuations will always carry higher inherent risk due to subjectivity.
Makes sense.
A crucial step is to evaluate whether the methods, data, and significant assumptions used by management are reasonable and in conformity with GAAP. This requires deep professional judgment and often a sophisticated understanding of financial modeling and the specific market or asset class.
Do they ever need outside help themselves?
Absolutely. The auditor might consider the need for a specialist, such as a qualified valuation expert, if the fair value measurement is particularly complex or relies on highly specialized knowledge beyond the auditor's core expertise, like valuing unique real estate or complex derivatives.
Using their own expert to check the company's expert.
Sometimes, yes. They also meticulously evaluate the fair value measurement for indicators of potential management bias. This is a significant risk in subjective estimates where management might be tempted, consciously or unconsciously, to choose assumptions that present a more favorable picture.
Yeah.
Maybe to meet an earnings target or avoid recognizing an impairment loss.
So checking for any subtle attempts to make the numbers look better or worse than they objectively are.
Exactly. Auditors need professional skepticism here. They also evaluate whether fair value measurement disclosures are in conformity with GAAP, ensuring all required details about the valuation methodologies, significant assumptions, the sensitivity to changes in those assumptions, and the fair value hierarchy, level 1, 2, or 3, are provided clearly and accurately in the footnotes. Transparency is key, especially for level 3.
Checking the fine print matches the work done.
Yes. They must evaluate the sufficiency and appropriateness of the evidence obtained throughout their testing. Is there enough high-quality evidence to support the opinion on the fair values? Furthermore, auditors obtain relevant management representations. These are formal, written statements from management confirming things like the reasonableness of methods, data and assumptions used, management's intent and ability to carry out planned actions related to the investments, the completeness of disclosures, and the effect of subsequent events on fair value.
Getting management on record.
It's a required part of the audit evidence. Finally, they communicate relevant matters to those charged with governance, such as the audit committee, regarding the appropriateness of the accounting policies related to fair value measurements and any significant judgments or estimates involved. It's important to note that the auditor bases their evaluation on information available at the time of the audit. They are not responsible for predicting future conditions that might affect fair value measurements, only for the reasonableness of the estimates at a specific point in time based on available evidence.
That's a huge undertaking, especially with so much judgment involved. So how do they actually test these fair value measurements in practice? What are the practical, hands-on steps an auditor takes beyond just understanding the process?
In testing, auditors will, first and foremost, verify quoted market prices if they exist, especially for Level 1 assets, by comparing them directly to independent market sources. That's the easiest part.
Checking the level ones.
For more complex valuations, Level 2 and 3, they determine whether management's significant assumptions provide a reasonable basis for fair value measurements. They'll meticulously understand those assumptions, evaluate their appropriateness, and understand any changes to those assumptions from prior periods. Why did they change? Are the changes justified by market conditions or other factors?
Questioning the assumptions.
Deeply. They also consider management's intent and ability to carry out courses of action that may affect fair values, like their stated decision to hold or sell a security, as this directly impacts classification and therefore the relevance of fair value or the method used. Auditors also determine whether modifications made to observable information, for instance in Level 2 valuations, where an identical asset isn't traded, reflect assumptions that market participants would actually use when pricing the instrument.
Are the adjustments logical?
So are the adjustments they're making to similar assets or inactive markets actually logical and market-based, not just arbitrary or self-serving?
Exactly. They also evaluate whether the valuation model is appropriate given the entity's specific circumstances and the applicable financial reporting framework. Is a discounted cash flow model appropriate for this type of asset? Are the discount rates used reasonable given current market conditions and the risk of the asset? Is the model consistently applied?
Checking the model itself. Yes. They rigorously test the underlying data that feeds into these models for relevance, reliability, and susceptibility to management bias. Where did the inputs come from? Are they verifiable? Sometimes auditors will even develop their own auditor's point estimate or a range for comparison against management's estimate.
Doing their own calculation.
Yes, using their own assumptions or market data to provide an independent benchmark against which to evaluate management's numbers. If management's estimate falls outside the auditor's reasonable range, it raises serious questions. They also review subsequent events and transactions that occur after the balance sheet date, but before the date of the auditor's report for any evidence regarding fair value measurements at the balance sheet date.
Things that happened after year-end.
Yes. These events can often provide clarity or confirm prior estimates. For example, if an illiquid asset valued using Level 3 inputs is suddenly sold post-year-end, that actual sale price might provide strong evidence about its fair value at year-end. And, as mentioned, if a specialist is used by the company or the auditor must deeply understand the methods and assumptions used by that specialist to determine fair values, as the auditor remains ultimately responsible for the audit opinion, not the specialist.
Okay, that makes sense. Sometimes auditors rely heavily on outside help for pricing, especially for those Level 2 and 3 assets where there isn't a clear market price. How do they know if that information is trustworthy, whether it's from independent pricing services that provide data feeds or individual broker-dealers giving quotes? What's the auditor's due diligence here on those third-party sources?
That's an incredibly critical question, especially for instruments not actively traded on public exchanges, where reliance on third parties is common. When auditors obtain pricing information from pricing services, like those providing daily bond prices, the reliability depends on several factors.
Like what?
The experience and expertise of the service itself. Are they reputable? What's their track record? The methodology they use to derive prices. Is it a robust, recognized model or more of a black box? Is it transparent? And, crucially, whether the pricing service has any relationship with the entity being audited, which could potentially impair its objectivity.
Checking for independence.
Absolutely. The relevance of the information, meaning its direct relationship to the assertion being tested, like valuation, is affected by the basis of fair value measurement. For example, if the fair value provided by the service is based on an identical instrument with recent active transactions, Level 1, it provides far more persuasive evidence than if the instrument has no recent transactions and the price is largely based on the pricing service's proprietary assumptions and modeling, closer to Level 3.
So, understanding how the pricing service got the number.
Yes. Interestingly, when using information from multiple pricing services for the same security, less detailed information might be needed about the particular methods and inputs used by each individual service, as their convergence, if they all arrive at similar prices, can itself be strong evidence of reliability and independence. It suggests a market consensus.
So, a consensus among experts adds credibility. And what about when they rely on individual broker-dealers for quotes, maybe for a specific illiquid bond or derivative? What makes their quotes trustworthy?
For broker-dealers, when a fair value measurement is based on their quote, the relevance and reliability depend on several factors too. First, whether the broker-dealer is a market maker for similar
A
instruments.
market maker, meaning they actively trade it.
Yes, meaning they actively facilitate buying and selling of that specific type of security, holding inventory and quoting prices. A market maker's quote is generally more reliable because they are in the business of standing ready to trade at or near that price. Second, any relationship with the entity that could pose a conflict of interest must be scrutinized. Is the broker also their underwriter or advisor?
Checking independence again.
Always. Third, whether the quote reflects current market conditions as of the financial statement date. Is it fresh? Fourth, whether the quote is binding on the broker-dealer.
Binding, meaning they have to honor it.
Yes, meaning they are obligated to honor it if the company decides to trade at that price, versus just an indicative quote which is non-binding. A binding quote is significantly more reliable. And finally, whether there are any limitations or disclaimers in the quote itself that might affect its interpretation.
So look for the fine print on the quote, too.
Exactly. Broker quotes generally provide the most relevant and reliable evidence when they are timely, binding, without any restrictions or disclaimers, and come from unaffiliated market makers transacting in the same type of financial instrument. Essentially, the less subjective, the more concrete, the more independent, and the more current the quote, the stronger the audit evidence it provides.
Okay, we've talked a lot about valuing investments in normal circumstances, getting the fair value right. But what if that value drops significantly, not just a temporary dip in the market? When does a temporary dip become something more serious, something that needs to be officially recorded as a permanent loss, known as impairment? This is the when things go wrong scenario, right?
It absolutely is, and it's a critical area for auditors, as recognizing impairment can significantly impact a company's reported earnings and overall financial health. An impairment loss must be recorded if a decline in fair value below the cost, or amortized cost for HTM, is determined by management to be other than temporary.
Other than temporary, that sounds a bit vague. How is that determined?
It is inherently judgmental, which is why it's so challenging. It means it's not just a passing market fluctuation. It's considered a fundamental and lasting decrease in value that the company does not expect to recover back to its cost basis in the foreseeable future. If management has already recorded an impairment loss, the auditor's role is to rigorously evaluate management's basis for that decision, their assumptions, their supporting evidence, and how they conclusively determined it was other than temporary. This requires significant professional judgment and skepticism from the auditor.
But what if management hasn't recorded an impairment loss, even though the value has clearly dropped? It seems like a prime area where a company might want to avoid recognizing bad news if they can.
You're exactly right. This is a high-risk area. If an impairment loss has not been recorded, but indicators strongly exist that suggest one might be needed, the auditor must proactively challenge management and consider if an impairment loss is indeed required under GAAP. They look for several key indicators that signal an other than temporary decline.
What are those indicators?
The first major one is if the fair value is significantly below its original cost, or amortized cost, and that decline is attributable to adverse conditions specifically related to the security itself, or to specific adverse conditions in the issuer's industry, or a particular geographic area where they operate.
So not just a general market downturn affecting everyone, but something targeted at this investment or its issuer, indicating a fundamental problem.
Exactly. It points to something more specific and potentially permanent than just market sentiment. Another key factor is if the decline has persisted for an extended period of time. A short-term dip of a few weeks or even months might be temporary, but a prolonged decline over several quarters or even a year or more signals something more fundamental and less likely to reverse quickly. There's often a threshold, like being below cost for 9–12 months, that triggers closer scrutiny.
Okay, significant drop, specific reason, lasts a while. What else?
Another crucial indicator relates back to management's intent and ability. If management does not possess both the intent and the ability to hold the security for a period of time sufficient to allow for any anticipated recovery in fair value back to its cost.
So if they plan to sell it soon anyway, or they can't afford to wait for a recovery?
Exactly. If they
Yeah.
plan to sell it soon while it's still below cost, or if they genuinely might be forced to sell it for liquidity reasons before it has a chance to recover, then that potential recovery won't materialize for them, and an impairment reflecting the current loss is likely required now.
So it's not just about the market potentially recovering someday, but also about the company's own strategy, cash flow needs, and capacity to wait it out. What else might signal an impairment? Almost like warning bells going off for the auditor.
Other strong indicators include if the security has been downgraded by a rating agency like Moody's or S&P. A significant downgrade signals increased credit risk and diminished financial health of the issuer, directly impacting the investment's likely recoverable value.
A credit downgrade is a big red flag.
Huge. Also, if the financial condition of the issuer has deteriorated significantly, for example, if a bond issuer is facing bankruptcy proceedings, has recurring losses, or a company whose stock you own is losing major market share or facing serious litigation, that's a direct threat to the value of their securities.
Trouble at the company you invested in.
Right. Furthermore, if dividends have been reduced or eliminated on an equity security, or if scheduled interest payments have not been made on a debt security, these are very clear, undeniable signals of distress for an equity or debt investment, respectively. It shows the issuer can't meet its obligations.
Missing payments is bad news.
Definitely. Finally, if the entity recorded losses from the security subsequent to the end of the reporting period, but before the audit report date, maybe they sold it at a loss after year-end, that subsequent information can provide crucial evidence that an impairment condition was already present at the balance sheet date, even if it wasn't fully clear then. All these indicators demand rigorous scrutiny from the auditor to challenge management and determine if an other than temporary impairment loss is required under GAAP to present a true and fair view of the company's financial position.
So what does this all mean for us, the listeners? We've covered a tremendous amount of ground here, everything from the foundational pillars of authorization, custody, and record-keeping for investments,
The core controls.
to the intricate art and science of classifying investments, auditing their balances and transactions, navigating the complexities of fair value measurement with its level 1, 2, and 3 hierarchy.
Which can get really complex.
And finally, understanding when an investment's decline in value is serious enough to trigger an impairment loss, a true write-down. It's clear there's an immense, often invisible amount of work behind the scenes by both companies and their auditors to ensure those investment numbers on the financial statements are trustworthy.
This deep dive truly shows us that behind every number on a financial statement, especially those seemingly simple lines related to investments, there's an incredibly layered process. It involves robust controls, detailed verification procedures, reliance on complex estimations and external data, and perhaps most importantly, critical, often subjective, professional judgment from both management and auditors.
Yeah, judgment seems key at almost every step.
It really is. And hopefully this raises an important question for you, our listener, to ponder. How much more confident are you now in trusting the financial reports you encounter, understanding the immense detailed work that goes into them, especially in complex areas like investments? And perhaps appreciating why a careful, objective, and skeptical audit is absolutely indispensable for the integrity of our financial markets.
Absolutely.
Knowing what goes on behind the scenes allows you to look at a company's investment portfolio not just as a single number on a page, but as a carefully constructed, verified, and hopefully transparent part of their overall financial story, with all its inherent risks and judgments disclosed.